From a CEO's bird eye view, are we just looking at a brief supply chain hiccup, or is the global helium market entering a permanent structural squeeze that will last for years?
Yeah, great question. And I'll try not to predict prices because I think that's a dangerous game to always play. But like stepping back.
Hello, everyone. Welcome back to the studio. When most people think of the tech boom, they think of software, AI algorithm, and data centers. But the entire modern economy, from the microchips in our phones to the rockets launching into deep space and the MRI machines saving lives in our hospitals, runs on an invisible, finite resource that the world is rapidly running out of: helium. Today, we are tracking how the global supply chain is being rewritten from right here at home. Joining us is Ryan, President and CEO of U.S. Energy Corp, a company transforming how we secure critical industrial gases and manage carbon. Ryan, welcome to the show.
Hey, good morning. Thank you for having me.
Yes. So, Ryan, you have deep roots in traditional energy and industry built on oil and gas. But lately, your focus has sharply pivoted towards industrial gases and carbon capture. So, Ryan, take us behind closed doors. What was that specific moment or data point where you realized helium wasn't just a side project, but the absolute cornerstone of U.S. energy future?
Yeah, great question. And as you mentioned, myself and the team here have a fairly robust background in the oil and gas space, and we're always looking at and evaluating our asset base. And one of our assets that we owned in Montana a couple of years ago, when we started reevaluating our overall portfolio, we came up with a thesis that we really found attractive, that we were sitting on potentially one of the largest helium deposits and carbon capture assets in the United States. So I think it all really starts with your asset base, right? Like, you can want something, but if you don't have it, it's never going to work. And we got very comfortable with the geology of the asset that we own. And then you combine that at the same time, call it early mid 2023, with helium really getting into the news, in my opinion, for the first time in my career. Just the market understanding that it's an extremely critical gas, prices starting to reflect that, and then concurrently, all of the federal bipartisan carbon capture stuff continuing to move forward. And then fast forwarding a very long diligence process that U.S. Energy conducted. We got very comfortable with what we had. We believed that the economics were robust, and we correctly believe up to this point that the market had a real need for something like this outside of just traditional oil and gas. So we decided to really pivot our business. Pivot is always a funny word because so much that goes into the industrial gas world are core competencies of the oil world, just drilling, processing, handling those kind of supplies, and really positioned our company to sell off other stuff, recycle that capital into this project, and really get it going to a full scale development.
Right, right. Right now, a lot of players in your space look at the market and just see traditional oil and gas infrastructure. You saw an entirely different map, a massive gap in North America, how North America secures its high-tech supply chain. There was that critical market weakness that everyone else was sleeping on, which made you say, we need to anchor ourselves in the domestic industrial gas space right now.
Yeah, great question. It's a little bit repetitive of kind of what I just said. I think helium has always been thought about as nothing more than what you put in balloons at your kids' parties, and kind of glossed over after that point. So what really was like the light bulb to me was twofold. It's what industries use it and have to have it, and it's not just children's balloons. It's semiconductors, it's AI, it's
Right.
healthcare, it's
Right.
United States missile defense systems, like the things that cannot happen um, without helium. And then
Right.
secondarily, you look at global supply historically, rough numbers, a third of the helium produced comes from Russia, a third comes from Qatar, and a third comes from the United States.
Okay.
And I would say that one of those places is probably not like the other two in terms of stability uh, and pricing and where it goes in the market. Now, obviously, I'm referring to the U.S. So you combine all of those things, us being in the U.S., us having domestic supply,
Mhm.
and the light bulb kind of went off
Okay. Okay. Okay.
internally on this is a platform that is a need that doesn't exist currently in the United States, and it's something we should push forward.
Right. Right. Let's talk about execution. Wall Street loves a good concept, but it loves cash flow and validation even more. Your you recently locked down a massive 5-year helium offtake agreement for your big sky carbon hub. For our listeners trying to understand the business model, how fundamentally does an agreement like this de-risk the asset, shifting big sky from an exciting exploration project into an active commercial gas platform?
Yeah, it's. I mean, simply put, it's absolutely massive for us. I think when you look at the market, the largest helium producer in the United States is Exxon, and
Right.
there's not a lot of guys below that. And when you get to the smaller producers of helium, a very major point is who is your offtake partner to buy your product, and there's a very large bifurcation of those groups that buy those products. In one bucket, you have your massive global, some of the biggest companies in the world, industrial gas companies, and on the other hand, you have much smaller guys. It was very important for us to get into that first bucket with a long-term infrastructure heavy distribution channels already fully established, and have that group be our partner that is buying um, all of our helium. So you can underwrite and you can plan for those type of cash flows from that level of investment grade counterparty uh, that we have. I think it gives us a credibility boost that somebody of that size would partner with a company of our size, and it also kind of gives us a foot in the door as we move forward in the future and greatly scale this project to kind of already be in bed with the best option that's out there. So it was a massive event for us.
Right. 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 So, Ryan, if you're sitting down with institutional investors who only buy SaaS or biotech stocks and has never touched a traditional energy asset, how do you explain US energy role in building the infrastructure that keeps their high-tech worlds online?
No, that's right, and it's really just understanding that some of the unknown feedstocks and critical supply chain elements that start at the very bottom of all of those processes you just mentioned are hard to get. They're hard to get, they're hard to find, they're hard to process, and they're hard to get to the market. And they have an extremely long lead time. So if you're an investor and you're long AI and you're long aerospace and you're long healthcare, which generally I would say the vast majority of the investment community is, you're also de facto long helium, because if one of them doesn't happen, the other is going to have a problem as well. So if you're long the end product, whatever industry that end product is,
Mhm.
right now, helium is a critical feedstock to all of
Okay.
those industries. And if you don't have it, those industries don't function.
Oh, yeah. Makes a lot of sense. Yes. So, Ryan, we have all heard rumblings about a global helium shortage. Meanwhile, semiconductor fabrication, aerospace, and advanced manufacturing are consuming it faster than ever before. From a CEO's bird eye view, are we just looking at a brief supply chain hiccup, or is the global helium market entering a permanent structural squeeze that will last for years?
Yeah, great question. And I'll try not to predict prices because I think that's a dangerous game to always play. But like stepping back, I think if you look at the economy, both U.S. domestic and overall, where it's going is it's always going more high tech. It's going more semiconductors. Defense budgets are bigger than ever, and you have to have helium to supply that. So I think that you'll always see spikes no matter what commodity you're in. I don't care if it's oil, if it's helium, if it's one of the other 1,000 commodities out there, right? Like you're never going to have a linear up and to the right price. What I do think, I believe very strongly in, is that the use case for helium and several other industrial gases, that floor is going to continue to be raised. You'll always see price spikes, you'll always see price pullbacks. That's just the nature of the market. But I do think that the floor on these pricings is going to continue to incrementally increase, just because the use case forecasted for the next 50 years, it just continues to grow in a fairly large manner. So I mean, I'm very positive on the long-term predictable prices of helium. Like any commodity, you don't ever want it to go parabolic because it feels good up front, but long term, it starts affecting the end users if their costs get too much. But in this range we're in right now, it provides for robust economics from the producer side.
Right. So, Ryan, you talk about prices. When you mix historic inflation, geopolitical gridlock, and skyrocketing demand, what happens to the price of helium and other such industrial gases? Are the days of cheap, abundant industrial gases officially over?
Well, that's a very good question, and it's a lot of dollars riding on that question. I think stepping back from like a global macro perspective, you haven't seen the cost of too many things ever go down. I mean, like flat screen TVs is probably the only one. Everything else continues to get more expensive as you go on, and I don't view any of these industrial gases or commodities any differently than that, right?
Okay.
Like inflation is real. The cost of all these things are going to continue to go up. The demand is going to continue to go up. I think it's a rising tide, whether that's good or bad for the end consumer, that things probably aren't going to get cheaper over the next 5, 10, 20, 30 years. So I think like the majority of other items, all of these industrial gases are going to, continue to, at a minimum, creep up at something more, elevate significantly.
Okay. Okay. Ryan, your recent offtake contract features a fixed price structure tied to a consumer price index, inflation escalation. In an era where commodity market fluctuates wildly month to month, how vital was the specific structure to guarantee predictable revenue to your shareholders while fully insulating the company against inflation?
Yeah, it was critical, right? It was critical both, I'd say, from a market perspective and being able to call it model out what we're doing and how this company looks from a financial perspective, and then internally, um, the capital needed to bring this project online is significant for a company our size, and having a highly predictable day one revenue stream at economics that work really, really well for us was absolutely critical. I mean, to get that going.
Okay. Okay. Ryan, are you noticing a psychological shift in Fortune 500 purchasing departments? Are procurement officers suddenly willing to pay a premium for ironclad long-term reliability over rolling the dice on cheaper, volatile spot prices?
Yes, I think simplistically the answer is yes. A lot of the market already operates on long-term agreements. A very small portion of it transacts at what we call spot, and there's not really a spot price. I mean, there's always a spot price by definition of what you pay for it today, but there's not an active spot market. The vast majority of helium contracts, both the gaseous producers like U.S. Energy, who sell it to the big distributors that liquefy it, from the big distributors that sell it to the end user client, the vast majority of those operate on long-term offtake agreements. This year alone, we've seen, again, this is a ballpark number, roughly a 50 to 75% increase in the long-term offtake prices for guys like us.
Oh,
Mixed in the domestic nature, and these distributors for U.S. end users are always going to want to secure a domestic supply over anything else. So the terms of these contracts, the pricing's gone up, and the terms, as you mentioned, CPI escalation, pricing revisiting, a bunch of other little things that go into that. Have gotten much more easy for companies our size to achieve, as you saw reflected in our contract. So I think like structurally, the mechanism of long-term offtakes has already been there, and will continue to be there, whether it's 3, 5, 10-year type of offtake agreements. But pricing and kind of the qualitative terms of those contracts have gotten much more beneficial to the ground level producers like we are.
okay. Uh, Ryan, when a major international processing hub gets hit with the sanctions or foreign pipeline goes down, what happens to your inbox the next morning? How do global wildcards reshape your day-to-day conversation with prospective buyers?
Yeah, I mean, from if by buyers you mean like the big industrial gas distribution companies,
Right.
it makes it much easier to negotiate from our side, contract terms, etc. Helium's such a global market; it's still a very opaque market that
Oh,
even some of the biggest companies in the world don't have great visibility to where the supplies they need globally are coming. So it makes the inbounds, whether from prospective buyers of our products or existing conversations that we're already having, um, it gives us a lot of leverage, right? It gives us beneficial terms. Just having that near term, large scale domestic supply ready to take to market in the next, less than a year, not 9 months or so.
mhm. Okay. So, what makes US Energy unique is that you aren't just selling a commodity. You have deeply integrated carbon management right alongside your helium operations at Big Sky. Ryan, how does blending helium production with carbon management build a diversified business model that can thrive even if traditional economic cycles experience a sudden downturn?
Yeah, that's a great question. And it's absolutely critical to everything that we're doing. What if for those of you who are familiar with the helium world, um, helium's hard to find, and the volumes aren't huge, even for the biggest producers when you compare it to other gases and other commodities. And what you've seen historically and today, in my opinion, is that if you do not have a byproduct or a secondary or a third revenue stream as part of your helium production, what you're producing is still extremely critical, but it's hard to scale. The numbers aren't big. I think 97% or something like that of world helium supply comes from natural gas operations, where the operators are already making a lot of money on the natural gas, and helium is a secondary process for them and a secondary revenue that's not nearly as big as their overall natural gas revenue. You look at Exxon, mention them again, they
Right.
fit that bill. They fit that bill perfectly. Helium is a drop in the bucket for them, even though they produce a lot of it. So our asset in Montana, very fortuitous for us, has ideal geology to permanently sequester and utilize CO2. As part of our process, we don't have our helium coming from a natural gas stream. It's its own stream, and as part of processing and purifying that helium, a large amount of CO2 is created, and we capture 100% of that CO2 as part of that helium process. And with our asset base that we have in Montana, we're able to permanently sequester a portion of that CO2 and utilize a portion of that CO2 to increase nearby oil production that we also own and operate. And we we make a lot of money on that process. So we have one well coming out of the ground that's producing helium, but on the full cycle of our economics, we really get paid three times for that helium molecule. We get paid for the helium, we get paid for the process of capturing and sequestering and utilizing the CO2, and then we get paid for increased oil production from that CO2, increasing the reservoir pressure of our very nearby oil field. So you're spending dollars for one process, but that process is leading to three different revenue streams. So it's critical.
Okay. Okay. Brian, building heavy infrastructure always involves friction, whether it's supply chain, lag, regulatory red tape, or engineering hurdles. So, Ryan, tell me, what is the primary execution risk that you are laser focused on managing right now to ensure Big Sky hits its timelines without a hitch?
Yeah, I mean that's an easy one, right? Like the execution of our project now between now and the end of the year on the construction side is it for us right now. We've laid out to the market so many hurdles, and we've accomplished the vast majority of those hurdles. I mean, most of the big ones being over the last 4 to 8 weeks, raising capital, started construction of our processing plant, signing our helium offtake agreement, etc. So right now, it's really making sure that we stay in line with costs, we stay in line with timeline, and everything follows our planning chart that we've developed uh, here. And concurrently with that, I would say this asset is so large that phase one of what we're doing right now is just that. It's phase one. You're starting from scratch. There's a lot of costs that go into phase one that won't be repetitive as we scale up, and really making sure that we're efficient with our capital spending. So as we move forward and grow and scale this project, the infrastructure that we put in day one, we don't have to spend again when we expand going forward. So I think it's remaining capital efficient, and it's remaining laser focused on execution and timelines of putting in our last leg of our processing infrastructure.
Right, right. A decade from now, when we look back at the reshoring of American manufacturing and the race for supply chain independence, what do you want the legacy of U.S. Energy Corp to be?
Absolutely, and I think we're very very focused on that. And what does U.S. Energy look like going forward over the next 5 to 10 years? And I think we're positioning the company now. We have the asset. We're getting it off the ground, but to be a sizable, scalable in-market provider of critical supplies that feed the biggest areas of the United States. I think that we have a very good opportunity here over that defined time period to provide, I'll call it a mid-single digit percentage of all United States helium production. And that's a really big number, right? Like when you're talking about the entire United States. I think that as well, leveraging our assets and creating a carbon management hub in Montana, not just for our own processes, but for other large emitters that are around us up there, really makes this a unique problem solving entity, both on the supply side and then both solving other people's decarbonization efforts.
Right, right. So that's all for today. Massive thanks to Ryan for joining us. If you want to track the future of tech supply chains and energy independence, keep your eyes on U.S. Energy Corp as they head towards 2027. We'll see you on the next episode. Thank you very much.